Hello and welcome to Morning Markets. I'm Roger Peterson. Thank you very much for joining us. Here are some of the stories we're tracking for you in the BNN Bloomberg newsroom. U.S. Attorney Jeanine Pirro says she's dropping her investigation into building renovation cost overruns by the Federal Reserve in a post made to social media today. Pirro says the probe was finished. However, she warned she would not hesitate to restart a criminal investigation should the facts warrant doing so. Jerome Powell's term as chair is scheduled to expire on May 15th, and President Donald Trump has nominated former Fed Governor Kevin Warsh to replace him. The federal government has approved a major natural gas expansion project in British Columbia. Ottawa says the $4 billion Sunrise expansion program will add capacity to Enbridge's West Coast pipeline system, helping to meet growing energy demands in the province. The government adds construction will begin this summer, and the project will support LNG exports, create jobs, and generate new tax revenue. Canada's February retail sales rose less than expected. Stats Canada says overall retail sales increased 0.7% in February, coming in below forecasts, which were around 0.9%. Motor vehicles and part sales were the top performers for the month. The data suggests consumers are still spending, but doing so cautiously as higher prices and borrowing costs continue to weigh on demand. And markets are getting a lift today as investors grow optimistic that the U.S. and Iran are again moving closer to peace talks and a possible peace in the region. Our next guest says that despite the near-term volatility, he remains bullish long-term. Let's get more now from Phil Orlando, Chief Market Strategist at Federated Hermes. And Phil, thanks very much for joining us today.
Good morning, Roger. Thank you very much for having me on.
Okay, what gives you that bullish optimism?
Well, stocks ultimately reflect economic growth and corporate earnings growth, and corporate earnings growth is very strong. You know, we're about a quarter of the way through the first quarter earnings season. Just as an example, revenues are up about 10% year over year, or earnings are up almost 30% year over year. Now, we don't think we'll end the earnings season at that level. We think we'll be up about 15 to 20%. But that's, you know, above trend line. You look out at the trajectory of earnings growth over the next couple of years, and we think we've got a compound annual growth rate of about 14%. So therefore, longer term, despite the near-term volatility, we do think stocks are going to continue to work longer term. Throw a couple of percentage points of dividend yield on top of that, you've got some decent returns for investors.
And is that 14%, is that a fairly balanced across the board, or are a few companies doing all the heavy lifting?
Well, in the current period, excellent question, Roger. Most of the upgrades in earnings estimates are coming from the energy sector and the technology sector. Most of the other sectors are fairly steady state. So you've got to recognize that the price of West Texas Intermediate oil, for example, as a result of this conflict going on in the Middle East, oil prices jumped by about 80%. Over a short amount of time. Now, they've come down, but they're still not back to $65 a barrel. You know, oil is probably sitting in that $90 to $100 neighborhood now. So I think what a lot of the energy companies are looking at is the fact that the base level for crude prices that perhaps they had in their estimates last year, let's call it $65 to keep the math easy, is probably too low. And if we're looking at $75 or $85 a barrel longer term, that's going to generate, more profitability for these energy companies.
Good for them, but puts pressure on other companies with their expenses. How much of a factor is that if oil stays up around $80 or $85 a barrel?
Well, the benefit to American consumers is that at 13.7 million barrels a day, the United States is the largest energy producer in the world. So we've got the ability to serve most of our own domestic needs. We've got a fairly sizable strategic petroleum reserve. as opposed to other countries, for example, in Europe and Asia, that are more dependent upon Middle Eastern crude and natural gas. So if I'm looking regionally across the globe, the U.S. is probably better positioned. But I'd be a lot happier, Roger, if WTI was back at $50 or $60 a barrel rather than 100.
I have a 95-liter gas tank. I'd be a lot happier if it was down there too. With what's going on in the Middle East, it seems like the markets have factored in that there is going to be some kind of a settlement, and sooner rather than later. If we do hear any news like that, do you think you'll see any market reaction to it? Will it be muted, or will there be another surge again?
I think the equity market, as a forward-looking discounting mechanism, has already priced in the ceasefire and the eventual resolution. You just look at the S&P 500 as one example. The S&P dropped about 10% in the early stages of this conflict, and has had a very powerful rally, up about 13 or 14% over a couple of weeks. That's the strongest rally to a new record high after an 8% or greater correction that we've seen in the S&P 500 in 75 years. So I think the equity market is already demonstrating a tremendous amount of enthusiasm and confidence that this will be a ceasefire that theoretically is going to hold. So if there's some sand in the gears here, and somehow this thing drags on or gets derailed, I think you've got the potential for a little bit of an air pocket as investors recognize that perhaps they were a bit too overly optimistic.
And so with all this going on, what are you looking at? What are you preferring? Value you're looking at, to what's catching your eye?
Well, I think that's exactly right. You've got a lot of uncertainty relating to the settling of the Iran conflict. Two other things that we can just throw on the bonfire here is that we're in the midst of a leadership and monetary policy transition at the Federal Reserve. That doesn't happen every day, and we are in a midterm election year, which historically is the most volatile of the 4 years within the four-year presidential election cycle. So for all those reasons, we're playing a little bit of defense here in the beginning of the year. We like international stocks. We like value stocks. We like smaller cap stocks. They are all much cheaper than the growth and technology names, these Mag 7 names that have done really, really well over the last couple of years, but the valuations are pretty stretched. So I think we'd prefer to have some better positioned, less expensive companies that have some significant yield support until we've got some better clarity on exactly how all these fundamental issues are going to shape up.
And how about money? Where are you sitting with money?
I'm sorry, in terms of money market funds?
Yeah, or just on to, are you sitting on any money? I'm just misreading
in terms of the asset allocation,
yeah.
We've got a 6% overweight to equities. So in a 60-40 balanced portfolio, we'd be approximately 66% stocks, 34% fixed income and cash. So we are, underweight, that portion of the equation. We like stocks longer term. We think you're going to generate, some stronger returns looking out over the course of the balance of this year and next year. My only suggestion is there may be increased volatility in the U.S. equity market over the next couple of quarters. So let's play some defense going into this thing and look for an opportunity to be vigilant and put some dry powder to work later in the year, and then run this thing up to higher levels once we've got some clarity on exactly how everything is going to shake out.
All right, we've got to wrap it up there, but Phil, thanks very much for joining us.
Thank you very much for having me. Have a nice weekend.
You too. Phil Orlando, Chief Market Strategist at Federated Hermes. Up next, Canada's February retail sales rose less than expected. We'll see what today's numbers say about the consumer after the break. Canadian retail sales rose 0.7% in February. The gains were led by auto dealers, with most retail subsectors posting increases. Let's get some insight now into the retail sector in Canada with Kim Furlong, President and CEO of the Retail Council of Canada. Kim, thanks very much for joining us.
Nice to be here, Roger.
Okay, the numbers today, a little below analysts' expectations, but in line, reasonable still?
Yeah, resilient is what we would see for February, at least. And that's what Statistics Canada reported this morning.
And where's that resilience coming from? I asked that question earlier. We have a lot of concerns going on. Where's that coming from for Canadians and consumers?
I think it's in value. I think the segments that we're seeing doing very well is value in grocery, value across the retail chain, and competitive pricing, and retailers trying to respond to a consumer that's stretching every dollar.
And is that putting pressure on the retailers then too?
Oh, there's so much pressure on the retailers. While Statistics Canada reported their February numbers, we see data at the council on a regular basis, on week to week, and for March, between the price of gas, the disruption, supply chains, and the continued challenge with the Canada-U.S. movement of goods, the pressure is continuous and heavy.
And now within these numbers, the automobile sales and part sales, it was up more than overall. Is that a good thing? And where did that come from? What's driving that? I mean, we saw some drops with it, concerns over tariffs and things like that. Do we know what changed that suddenly got people buying cars?
We don't really track at the council automotive, like we track core, so I can't really speak to the need. But the automotive segment has been one where the prices were elevated for some time. So it's possible that the retailers in that segment have chosen to try to attract the consumer with some competitive offerings.
Okay, and then how about then within the core? What did you see? And were there any little red flags?
So we saw some robustness, 4.2% higher than last year, same month. But again, the different segments, sporting goods was higher, surprisingly. Jewelry was higher than the last year. General merchandise also slightly higher, but all across, Roger, like very much into the value proposition that is out there. So retailers that are offering prices that are very competitive, and we see that in grocery with the value brands driving that growth.
And looking forward, inflation, Bank of Canada, where does this leave all that?
So talking about February, those numbers are robust. And if you look between December to the end of February, we were surprised by the resilience. But the numbers that we saw in March, we track foot traffic in stores. That was down by the end of March 30th, 23.4%. And Moneris also signals like a decrease in March in spending. So what you're seeing happening in the Gulf, the conflict in Iran, and the prices at the pump, really sending this like signals of caution that we can see through those early numbers for March.
And then looking forward, where do you see this as a continuing downward trend going beyond the next couple of months? Does it depend on if there's a resolution in the Middle East, or is this something that may drag on?
We expect that if there's a resolution in the Middle East, it will send a signal to the consumer that there's relief. For us as retailers, the ramifications of the conflict will last a number of months, as the futures on prices of oil will take some time to realign themselves to a normal base.
And now you mentioned a lot of retailers are feeling all kinds of pressure right now. Could this added oil, could that be something that puts a lot of them out of business?
Well, I don't know about out of business, but the stretch in terms of fuel surcharges for retailers from manufacturers are putting increasing pressure on prices. And the margins in retail and in food are 3%, general retail 6%. Not a lot of room there, Roger, to move. And so consumers can expect that if the conflict perdures, that we will see pricing be affected by that.
Now, one of the things retailers have been bringing in surveillance pricing, and a lot of people concerned about it, saying they're changing prices for individuals depending on your shopping habits, et cetera, et cetera. You just put out an article about it, and you say it's not necessarily about that.
Well, the fact is that it's not happening. So there is this willingness to legislate something that we don't see in the market. There's certainly algorithmic pricing exists, and retailers from the beginning of time have used data from wage, transportation, cost of doing business to decide on their pricing and their pricing model in terms of when they will discount these prices to have the flow of inventory leave their shelves and meet the numbers that they need to track. This idea that there's what is underlying this debate is surveillance pricing, where the prices go up and retailers are charging more. Most of the data that's used is to provide discount and targeted discount to people where they can see that consumers are buying certain items and inviting them into their stores by giving them a discount and hoping on foot traffic to make sure that consumer sees value and is a continued repeat customer. So in the article that I published, we were quite clear that the evidence that any type of use of data to increase pricing is not happening in Canadian retail, and I'd love to see the evidence.
What would be your fears about policies brought in to try and interact with this? I want to say counteract, because you say it's not there, but to try and bring in rules for this?
Well, I think it could have a negative impact on the consumer and the ability of retailers to have these programs that, at the end of the day, a retailer wants a consumer to continually, choose them as the source of their purchasing habits. So if you're unable to communicate discounts and entice people to buy from you, that would be negative for the retailer, but also negative for the consumer who's looking for those discounts. And I will add, Roger, that in a world where you can go online and shop and compare prices, especially with the advent of AI, the consumer is really well equipped to be browsing back and forth and see who's offering the best price. It's a very, very competitive landscape.
Okay, we have to wrap it up there, Kim, but thank you very much for joining us.
My pleasure.
Kim Furlong is President and CEO of the Retail Council of Canada. Coming up, today's market drivers with Bloomberg's Monique Malima. Time to take a look at today's market movers, and we're joined for that by Bloomberg Equities reporter Monique Malima. Monique, thank you as always for joining us. Baker Hughes apparently doesn't know a war is on. They're just chugging along.
Yes, so Baker Hughes, they reported their first quarter earnings last night, and they beat on earnings per share. They saw a lot of strength in their industrial and energy technology segments, and they didn't see a lot of impact from the Middle East war. This is something that analysts are really positive on. A number of their peers saw a hit to their earnings because of the disruptions to some of their operations, but Baker Hughes saw continued strength and is also maintaining its guidance for the next quarter as well, which also shows that they're not expected to see as much of these impacts. And analysts also say that they might even see some benefits in the event if this war comes to an end soon, that they could also do some of the work with the remediation efforts to some of those energy operations for other providers in the Middle East.
All right, and Newmont also chugging along nicely and buying back some shares.
Yes, so Newmont, they reported earnings that beat for the first quarter. They saw higher levels of sales than what analysts were expecting. And they also announced, like you mentioned, that they're going to be buying back about $6 billion of their shares. And analysts are really positive on this for Newmont. The company also maintained its guidance, which they see as something really positive because Newmont has been dealing with higher energy costs, like a number of other companies as fuel prices have been rising. But they've been able to offset some of those higher costs with higher sales. So they're really expected to continue to see strength going into the next quarter as well.
All right, staying with energy, Phillips 66, how are they doing?
Yes, so Phillips 66, their shares are rising this morning after Morgan Stanley upgraded the stock to overweight. They are a refiner, and they've been able to benefit from some of the higher margins as a result of the war because some of the refining capacity and the production in the Middle East has been reduced. So those in the U.S. have been able to command higher prices, and Phillips 66 is one of those. They're also benefiting because they have a chemicals business, and we've seen the chemicals prices rising as well. But there's also some fundamental strength that the analysts see. They note that the operations have been improving for Phillips 66 and that they've been able to bring down their costs. So they really see a lot of upside for these shares going forward. And they note that even if the war comes to an end soon and the Strait of Hormuz opens back up, there's not going to be an immediate large impact to prices because it will take time for some of those Middle East operators to ramp back up to the level they were at before the war.
All right, one last one. We want to get this in because there's a lot going on. Amazon, I'll just say go.
Yes, so Amazon, their shares are higher this morning after Meta agreed to a multi-billion-dollar deal with Amazon to buy hundreds of thousands of Amazon chips. So these are general purpose chips that are going to be used for AI. So Meta is going to be renting these from Amazon. They can do actions like responding to queries and some of the other kind of more basic AI functions. And Meta is really trying to expand their AI capacity and is going to be using these chips to do so. And analysts are really positive on this because Amazon has a strong outlook for its AI chips business. They are targeting about $20 billion in sales over the next year. So this is going to be a growing area for the company.
All right, we'll wrap it up there. But thank you, as always, Monique, for joining us. Bloomberg's Monique Malema. When we come back, Intel shares just hit a record high. We'll find out why. That's after the break. Chinese exporters have started raising prices as the Iran war drives up input costs for certain goods. Companies say rising costs for plastics and other oil-related products are forcing them to pass those increases along. After years of cheaper Chinese exports helping hold prices down, economists warn this shift could start adding pressure to global consumer inflation. And Canadian AI company Cohere has signed a deal with Germany's Aleph Alpha in a bid to create an independent alternative artificial intelligence company. The companies say it will function as a transatlantic AI powerhouse anchored in Canada and Germany. They also announced today that the German company Schwarz Group will invest 500 million euros as the lead investor in an upcoming finance round. Shares of Procter & Gamble are up after the company beat sales expectations in the third quarter, driven by growth in the beauty category. The consumer goods giant saw the highest organic growth in more than a year, signaling steady demand for everyday products. P&G also maintained its outlook for its current fiscal year that ends in June, but the American company now projects higher commodity costs. And taking a quick look at the markets, and you can see the TSX down about 0.2%. Communications, tech are the ones pulling it down. Going the other way right now. Healthcare is up by about 2.5%. South of the border, you can see lots of green and a little bit of red in the middle there. It's like a sandwich. S&P 500 up by about a half point. The Dow off by 0.36. NASDAQ continues that rock and roll. It is just flying right now, up another 1.15. And of course, that's on some good earnings that we're going to talk about right now. Intel. Yeah, shares there hitting a record high after the chipmaker delivered a second quarter forecast that beat expectations. The AI-driven outlook led shares to eclipse the high from the dot-com era. It's up, look at that, almost 24% right now. Joining us to discuss that and more is Jay Goldberg, senior analyst at Seaport Research Partners. Jay, thanks very much for joining us.
Good morning.
What makes this report so good? Why is everybody loving Intel now?
I think that, if just to put it in the simplest terms, is suddenly the market realizes we need CPUs again. Right? For a long time, the whole AI run has been about GPUs that NVIDIA makes. And now we're realizing that we also need a lot of CPUs as well.
Why is that? Why has that caught people off guard?
I think people had just sort of forgotten about CPUs. We've been so excited about GPUs, about AI for so many years that we sort of all started to assume that CPUs were, not as important. We're more commoditized. And I don't think that's true. And I think for Intel, there's another thing going on which is, a year ago, there were legitimate questions about whether this company would survive, sort of existential questions. We've gotten past those. We think the company's going to survive. And on top of that, they're actually seeing demand for their products like they haven't seen in a long time.
Yeah, they're saying they can't keep up with orders. Is that a good or a bad thing?
That's a good thing because they'll be able to fix that. They have more capacity coming online later this year. They have a new manufacturing process called 14A that's ramping pretty well. So they'll be able to fix their capacity problems, which makes them different from everyone else in the sector who's sort of up against some pretty tight capacity constraints everywhere you look.
And with the GPUs and the CPUs, is there competition within them, or are they fairly separate things?
Yeah, there is still a lot of competition. Well, so there is different things you want to do with your computer. Sometimes you use a GPU, sometimes you use a CPU. It depends on what you're actually doing with it. Within CPUs, there's a fair amount of competition, right? Intel is up against AMD, who's also very formidable and is up as well today in sympathy. But then there are also a lot of the hyperscalers, Amazon, Google, all have their own CPUs as well. So there is more competition on the CPU side.
And what makes you think Intel can compete? I mean, Amazon, the big players here. What makes you think Amazon, after struggling, what makes you think they're ready to compete?
I mean, Intel was the CPU leader for 30, 40 years. They still have a lot of that capability inside them. And I think they're very much like a repressed spring where they were just held back by their own mistakes for many years. And now they're correcting to a place where they should have been if they hadn't gone through all those problems in the past.
Yeah.
They'll be the leader in this market.
Sorry, I didn't mean to jump in there. And with AI, what kind of a role do you see Intel playing with that, or is it a challenge to them?
I think they're going to benefit from AI. We're going to see lots of AI workloads today. All this talk about agentic AI, where you're using Claude to do multiple things, that lends itself very well to using one or two GPUs with one CPU, or even 1-to-1, right? And so they'll participate in that. More CPUs to go alongside the GPUs, and then on top of that, they have ambitions beyond that. They're working with a company called Sambanova to do more AI things. They have their own products in place. They're talking about doing custom AI chips for some of the big hyperscalers as well. So there's a lot of sort of broader AI opportunity for them out there. That's going to take a while to develop, though.
And now the U.S. government, I was just looking at this, its stake in Intel has now jumped 300% to $36 billion. Is that a good thing, a bad thing? How are people reading that?
I think, 6 months ago, you wouldn't have wanted to be short a stock that the U.S. government was long. Now I think that was sort of the bottom. That was a bottom tick for this. Now I think the U.S. government role is less critical to Intel's survival. Like I said, we're not talking about Intel's survival anymore. Government sort of backstopped that, and now it's just a surprisingly good investment by the U.S. government.
Could you see the government getting out of that, or are they going to hold on to it, do you think?
Asking me what's going to happen with this administration is way beyond that.
I tried. You never know. I mean, maybe we could flip a coin with that. One of the other things I just saw with Intel that just came up, they're going to plan a bond sale to buy the plant stake from Apollo.
That's right. They were in a sort of a sale leaseback deal with some of their factory, their fab properties around the world. The Apollo deal, I think, was a little bit constraining for them, let's say. And it's a good thing that they're getting out of it. They're just going to refinance it and retake ownership of it. And they have the balance sheet for that now. All
right. So that really won't have an impact on anything, you don't think?
I think it's a modest positive. It'll end up being accretive. They have to spend some money up front, but it'll help their earnings over the long term as that deal goes away.
All right. With Intel, what possible headwinds might there be over the next little while? I mean, we've talked about the war, but in Iran, would that have an impact, or is that something that's fairly separate from them?
I think the impact of the war on Iran is going to have impacts on all of us in a macro sense. I don't think there's any necessarily direct impacts on Intel here. I think the big theme in my sector in semis right now is all AI and all that construction that's taking place, and so that trade is still pretty strong. We're just going to ride out all these industry constraints for the next year.
The industry constraints being?
If you look at the AI supply chain, everything's constrained, right? NVIDIA can't get enough chips out of TSMC. TSMC can't get things like chemicals and substrates that they need, not because of Iran, just because they're all in, there's such demand for it. If you look at data center construction, there's a shortage of electricity. There's a shortage of different components of electrical, transformers and whatnot. And there's a shortage of electricians and plumbers to build these things. So everywhere you look, there's so much demand that there's a constraint, or somebody sold out everywhere along the supply chain.
So like Intel, though, that's not necessarily a bad thing. It's just something that needs to be dealt with.
Well, I think for the next 6 to 12 months, that's the trade, is looking for companies that have capacity that are benefiting from AI. Intel is a prime example here, both in their product side. Also, they're getting a lot of foundry business because their TSMC is sold out. So they're getting packaging deals. Companies like NVIDIA are going to struggle because we sort of know what their capacity is, and it's tough to beat to the upside when they're sold out, right? How do you surprise to the upside? Intel is one of those few companies out there that is actually able to increase capacity right now, and that's going to benefit them.
All right, we have to wrap it up there, but Jay, thanks very much for joining us.
Thank you.
Jay Goldberg, Senior Analyst at Seaport Research Partners. Coming up, shares of a software giant, SAP, are on the rise after the company reported cloud growth that beat estimates. We'll get you a conversation with the CFO of SAP after the break. SAP is getting a boost after the company reported revenue growth from its cloud services that beat analysts' estimates, driven in part by integration of artificial intelligence agents into the service. Now, earlier, Bloomberg spoke with Dominic Assam, CFO of SAP, about the quarterly results.
It has been a very solid start into the year, enabling us to confirm the outlook we have provided for 2026. We increased on constant currency terms cloud revenues by 27%. We increased our non-IFRS operating profit by 24%. If you then compare that to the ranges we've guided for the outlook, you see that this is actually above these ranges, giving us, so to speak, a head start, despite what I would consider a quite adverse environment, given what we've seen in the Gulf region.
In the Gulf region, have you seen big orders being put on ice? Has that been more challenging? Have you had to scale back the ability to ship product into the Middle East? Have customers turned cold in that region as a result of the geopolitics?
Obviously, those customers, governments, but also commercial customers that have been most directly impacted by the war in the region have been distracted by what I would call a lot of firefighting around the situation and have been pushing some projects to the right. But I'd say on a global basis, it's still very solid. And that's, of course, the big question. How long will this last? How long will the Strait of Hormuz be shut down to avoid a contagion of the global economy?
Yeah, something we're watching very carefully, Dominic. Good morning to you. Away from, well, more broadly, thinking about the pricing of your products and where you're moving to on that particular story, you're moving from a usage-based pricing model, from a subscription-based pricing model, and there's going to be a hit to margins, we understand. That's the expectation amongst analysts. What kind of timing and margin hit can you describe coming from that move?
Well, the consumption-based pricing that we have alluded to is really something that will be layered in over time in a very gradual way as AI agents will consume tokens. And that is not something that is happening from one day to the next. So it's nothing comparable to what we had when we transitioned from on-prem to the cloud, where we had to defer all the revenues to the right, where there was some cannibalization of the legacy business, so to speak. Here, AI is an opportunity coming on top, which will be then more consumption-based over time. So this is a much more gradual shift, and it's actually an expansion opportunity for us, and should also bode well for earnings growth.
OK, so, I mean, your CEO said recently that there would be short-term pain. Trying to understand how painful. You're not painting a picture of much pain there.
Well, the pain we've referred to is what you alluded to in your introductory comments, which is this kind of alleged SaaS apocalypse narrative, which has been around for the summer of last year and has, of course, left its traces in the share price. So Christian was really referring to the pressure on the share price here, as opposed to anything related to our outlook.
Why is it alleged? The market is deeply concerned around this. You're saying the market is wrong. What is the market getting wrong here?
Well, I think you cannot generalize that. I just talk about what we can see in our figures. And as I said, we had a very strong into 2026. We can confirm our outlook. So that doesn't kind of confirm an apocalypse-like meltdown that people are speculating about.
OK. Do you think 25% conversion rate onto the cloud is good enough? It wasn't that long ago you thought this number was quite disappointing. Do you think actually you are seeing some effect, but yes, you're confirming what was a fairly cautious guidance, Do you think that these numbers are good enough? Do you think that 25% conversion rate is good enough? And do you think, to Anna's point, that as you convert from subscription to a usage model, that you're just going to become more volatile as a business to own?
Well, first of all, let me just get this straight. We have by now more than 50% of our revenues in the cloud. So the conversion of on-prem customers to cloud is much more advanced to that. I'm not sure that is what you refer to, but that is really still in full swing. And the other thing I can say is just most recently, outside third-party prominent research institutes like IDC and Gartner have confirmed extremely high market share gains of SAP in the SaaS market. So I think we have a very special situation here at SAP because the type of processes, complex end-to-end processes we are dealing with, which are around monetary transactions, where the assurance levels are extremely high, and you have to provide that trust wrapper really to make sure that people can transact with confidence. It's a different game from a more content-driven, language-driven, or even vibe coding-driven environment. So I think that's where the kind of market share gains can be explained, and the continued strong momentum of SAP, despite the backdrop of AI revolutionizing basically everything. To the contrary, we want to be on the kind of side of leveraging that technology in our portfolio to harvest either higher hanging fruit, like the very complicated processes I've just alluded to.
Dominic, is Anthropic now your biggest competitor?
I think it's fair to say that they want to go where we are already. We are just right in these complex processes. Right now, of course, the lion's share of the ARR stories that you hear out there are still around large language models in a more traditional sense, doing chats with customers, services, coding, which is also some type of language. What we talk about is really the ultimate decision point of a transaction, triggering a monetary transaction that has consequences. You have to be first time right, very different assurance requirements. And there we are. That's our kind of core business. And of course, they want to go there. But rest assured, we want to lead that market as opposed to being a follower there.
Can I ask you another question, Dominic, about the pricing model then? Will there be options for people, for customers to stay on the status quo? If they don't want to move to a usage-based model, if they like the predictability of a subscription, can they stay there? Because even your CEO, I think, has acknowledged that it's quite difficult for some businesses to predict what a usage model will mean to their costs.
Yeah, it's indeed a big challenge for our customers. Many CIOs would love to have predictability. By the way, we have the same situation right now that consumption of tokens for coding goes through the roof as the adoption of these new AI tools also by our developers is really making great progress. It's becoming more expensive. But on the other side, you also have a great value added, a great productivity gain. So I think those vendors who have the leverage to give a differentiated offering to the customer that provides productivity will have some leverage in deciding what type of monetization model we give.
Okay, just to kind of stay with this theme, one of the reasons why private equity, private credit liked the software environment was that it did have predictable revenue. It was based on a subscription story. That was one of the big attractions of it. Do you think if you do move to a pay-per-use model, that your business will become more volatile? Or do you expect that actually there will be the same volatility or less volatility? What do you think happens in terms of your revenue volatility if you do move to this model?
Yeah. I mean, again, as I said already, that kind of consumption-based model is like an increment coming on top. So we have a very strong subscription-based. By the way, today already we have some consumption-based models like on the BTP. We have this BTP EA enterprise agreement credits where people for development are consuming credits. We have tools like Travel in Concur where people are paying per transaction. So it's not a new model. We have the metering in place for all that. It's now really more about the value creation with AI. We want to come from a cost-plus type of logic to participating in the value that our tools can deliver to the customer. And that's the strategy of many of our peers. But indeed, it's that dilemma that we have to manage the predictability on the one side for the customer and also for our cost base. I mean, if you spin these GPUs, it's not necessarily for free. Yeah? So also API calls on our infrastructure will be charged because we have some effort for that. We have some cost for that.
Yeah, so there's a cost there. There's a cost in the R&D that goes into building these AI products as well, Dominic. Does that mean you're going to have to trim headcount at some point?
Well, it's clear that we have an extremely dynamic environment in the tech industry, and the domain you point to, which is the development, is the one where the productivity gains have been most tangible, most impressive in the most recent past. And we will leverage to the full extent these new technologies. We have a lot of customers really pointing to certain feature gaps. We have been quite selective in the past about how many customers we need before we start developing solutions. I think with these new tools, we can really pull in the roadmap of deliverables from SAP, make sure that the customer needs are satisfied in a very speedy manner so that they don't need to do it themselves. And we still benefit from the economies of scale that we're not developing for one customer only, one company, but for myriads of customers. So that model is unbroken from our point of view. And the question what that exactly means for headcount is really hard to judge, because then we would look in the crystal ball and say what exactly will be there in terms of productivity gains. There are ranges out there, but for the time being, I would say let's really speed up, drive the top line, and make sure we are a strong winner in the AI race.
That was Dominic Assam, CFO of SAP, who was talking about the quarterly results. Coming up, we'll see why quantum computing could be the next major leap in technology. Quantum computing could be the next major leap in technology with the power to solve complex problems far beyond today's computers. We sat down with Tony Sierra from Caldwell Asset Management, who says Canada's strong position in quantum research could shape long-term innovation and investment.
In simple terms, today's computers can solve a problem binary. You know the answer is between 0 and 1,000,000, and it'll test each number until it comes down to the right number. And supercomputers can do that a lot faster. But quantum computing will test all the possible answers and point out the right one at a much quicker rate. So it has a quantum ability. Yeah. So not single bit, quantum bits to do so.
Do we know how much faster it is? Like, can they give you numbers on that? It's hard. It's faster.
Yeah, exactly. I like to say, let's look at medicine and drug discovery now. You're going to go through lots of trial and errors, many years to get something approved. Potentially, this can speed up the process quite sooner. And I'd say if it's 10 years, maybe it's down to 1 year or 2 years.
I saw a neat demonstration of how they work, and it's in a maze. If you were in a maze, and if you're a regular computer, you're going like this, you get to a dead end, you got to go back like this, then you go and find another one, you got to go back. And with quantum, it goes, and it just goes in every single direction and finds the other side.
Yeah, exactly.
And it just does it all like that.
Exactly. So it spirals out, and then it'll highlight the right answer for you.
And people, I think this is science fiction, but there are some out there, right? We're starting to see them.
Yeah, well, you're seeing rudimentary sources, and it's akin to the internet back in the late 90s when everybody was trying to develop it in their house or get it in their house, dial up and the noisy background, and the disconnect happened quite a bit. So I think that's where we are now.
And we still quantum.
Exactly. So we got so much runway.
Yeah.
Nowhere close to being mainstream and nowhere close for companies to make a profit on it. But Google Cloud Services, Amazon, AWS, and Azure by Microsoft, they offer what's known as QaaS, Quantum as a Service, and companies can use it and try to make themselves more efficient. But again, it's still in the rudimentary stages, and by no means are we making money off it.
But they are coming, and Waterloo, Ontario is one of the hotbeds in the world. Can we say that?
I'm going to say yes. U.S., when you look at quantum computing, you always have to look at the U.S. And
you
China's
wanted to talk about quantum computing, you can say it is. Well, I think it really is. I mean, it is a tech center, though. So.
Yes. University of Waterloo have made great strides on it, to the point that Carney announced a couple of weeks ago we're spending quite a bit on beefing up defense. Mm-hmm. They're looking at quantum computing components and how to expedite that, make that a lot more efficient, not as much costly. We're spending, $6 billion, I think was the total, and the U.S. spends that on one day with the Iran war. So we have to be a lot more efficient, and they're using components of quantum computing to make it so.
And are there companies that are rising to the or coming to the forefront or rising above the others here in Canada?
There is.
Or do you want to? If we don't want to get into names, that's fine.
One, I think they're called D-Wave. I'm not sure if they're Canadian or U.S. But again, coming out of March, when the markets were down about 5 or 6% in the U.S. and 3 or 4 here in Canada, when we turned the calendar over to April, all of a sudden quantum computing got the hits. And companies like this D-Wave had done quite well. INQ, I believe, in the US had done quite well, just about 30, 40% within a couple of days or so. So there was more talk, more rhetoric about quantum computing. That has since died down, but I just wanted to bring it to the forefront because it is something long-term. By no means, again, it's mainstream. Companies haven't figured out how to make revenues off it, but it is coming. I don't know if it's 10 years, 20 years, but it is.
Do you have any investments with them? And what are you looking for when you're looking at these companies? Because it's so off in the future, at least at this moment, it's off in the future, but sometimes all it takes is one change and all of a sudden it's here today.
Exactly. So we'll stick with the large cap. And as I mentioned before, it's the Amazon, Googles, and Microsoft. They have components figuring that out, but they're not making any revenues yet. Because they have billions of dollars on the balance sheet, worth trillions of dollars. We're sticking with them because if any breakthrough were to happen, they'll take advantage of it.
Was Tony Sierro, CEO and president of Caldwell Asset Management. Market Call is coming up today, and joining us on Market Call is Greg Newman, senior wealth advisor and portfolio manager at Newman Group. Scotia McLeod is focused North American equities. And that is it for Morning Markets. Thanks for joining us. Have yourself a great weekend. We'll see you on Monday.